I think this is a very interesting one. So, Ashtead Technology, it was full year report. It was out on Tuesday. The stock had a little jump off the back of it. Revenue was up at 168 million. That's up from 110 million. That's up 52.1%. Operating profit also jumped to 42.8 million from 31.2. That's up 37.1%. PBT, profit before tax, 36.1. Up from 27.5, again 31.1%. In terms of basic earnings per share in pence, 35.9 up from 27p, up 32.9. Return on invested capital, 24.3, down from 27.6. That's about a 330 basis points drop. Proposed full year dividend was lifted 9.1% from 1.1p to 1.2p. In terms of strategic highlights, they said that the acquisitions of Seatronics and J2 Subsea were completed in November 2024. They were the largest deals to date, and they expanded their equipment fleet and added increased depth and scale to their international locations. The integration is well advanced now, and that the cost synergies that they hope to make are on track. They've strengthened their footprint in key geographic locations, including Norway and the USA, which is obviously very good news for avoiding tariffs. They broaden customer solutions through fleet investment, innovation and acquisition, and further investment in strengthening the leadership team, continuing to build foundations for future growth. In terms of their outlook, they said strong market fundamentals underpin the group's growth strategy, supported by record levels of multi-year customer backlogs. Addressable market within their focus end markets of oil and gas and offshore renewables are going to grow around 9% CAGR through 2028. And they have continued confidence in delivering low double-digit organic revenue growth and EBITDA margins that will be in the high 20s over the medium term. There are significant opportunities for disciplined and strategic M&A, continuing to add strength and depth to their highly flexible, market-appropriate business model. They're going to continue to monitor the potential impact of tariffs. They think the position is fast-moving, but they're expecting minimal impact. They said they're encouraged by the group's performance in Q1 2025. They said their full year 2025 expectations remain unchanged. They're actually assessing a move to the main market, and they said they'll issue a further update following consultation with the company's advisors and large shareholders. CEO Alain Piri said, "We are delighted with our performance in 2024, exceeding our financial and strategic objectives. The group finished in the year larger, stronger, and more capable of delivering value to our customers. This is underpinned by the breadth of our offering and the flexibility of our international operating model. The integrations of Seatronics and J2 Subsea acquired in November is at an advanced stage, and the quality of what we acquired has exceeded our expectations." Reflecting on strong financial performance in 2024, the record backlogs being reported by our customers, and the strong growth fundamentals in core markets, we are confident in our ongoing positive momentum. With opportunities for both continued organic growth, disciplined M&A activity, we believe that we can further value create for our shareholders moving forward. About 12.5 times price to PBT, Steve, with 20% growth ahead. It's the same price today when we first covered it. And it's grown 50 odd percent since then. I think this is a good one, Steve. I think this one might do all right.
Bit of a Bloomsbury, isn't it? It's tough to kind of look at it when it's up from where we were before, but priced, pre-tax profits, as you were saying, were basically the same. There's a lot that's encouraging about this. I'll see you one thing that was sneaking. I'll talk about the obvious things in a minute, but here's one thing I thought was sneak encouraging. That dividend increase, you say it was up about 1 point something percent. Was that right on the dividend up?
No, it's up 9.1%. It's up 0.1 of a penny.
Right, 0.1 of a penny. Got it. Up 9.1%. So it's up more than I thought, which I was kind of impressed because there's some impressive ROIC numbers coming out of this. And I think given the opportunities that they appear to currently have, and they think they're still ahead of them in terms of organic growth and M&A opportunities here. I don't really want this company sending out huge amounts of cash via dividends here. Yield isn't super high on this one, and it's kind of the case that I think they would be well advised to keep it in-house and go using it if you can. Because to some extent, if you're achieving a 30-something return on invested capital, don't go giving the damn cash to me. I don't have a way to achieve 30 something percent on it, at least not easily. All I'm going to do is buy more shares in your thing and have you do it. Rather, you just held on to it and keep growing the business like that, which is sort of, I think, the way to think about this kind of company. Or indeed, when I think about investing in the stock market in general, it's because businesses can do things that people like me can't, which is find something that you can get a 30% ROIC on, which, I mean, it might be an opportunity for me, but I can't think of what it is to go about investing in that way. Anyway, double-digit revenue growth is pretty good going forward. That was over the kind of medium term as well. So this is kind of durably going higher. And you think that, yes, revenues were up more than the kind of further down the line things. So costs were slightly higher as well, it seems here. But margins came in. Margins were still looking decent. And if your revenues keep going up at 11% a year, it's hard to see how your profits can't follow sooner or later. And on a kind of ordinary PE basis, it doesn't look like it's massively priced for growth at this stage. You're looking at around sort of 15 or so, which is well, if you believe the right people, the magic Buffett number that he looks for. And if you're confident this will be in a stronger position going forward, then it's a pretty good goer here. Once you get into kind of cost synergies of these sorts of things, they become quite attractive, don't they? When you see it, you always see kind of revenues go first and margins contract a bit, and then they kind of level out here. When you look at the kind of timeline of those acquisitions, I wouldn't be at all surprised to see you get some margin expansion. And expanding margins could well drive profits higher on this. I think it looks interesting. We've talked before about this as being a potential playing both sides of the kind of energy debate, with whether you think oil and gas drilling is got likely to be more durable, or whether you think the shift to renewables is inevitable. This company has something for you on both of those things. Both will need equipment. Both will not want to buy that equipment. They will want to rent it out from somewhere. Ashtead Technology is in quite a nice position and strengthening in US and Norway, a nice position to try and make the most of that, I think. I was going to say ask where they think this kind of double-digit revenue growth is going to come from, but to some extent, it doesn't really matter. Someone got a general rising energy demand, got to come from somewhere.
Yeah, so the two bits in the report that I'd really want to highlight that, I did list them, but just to highlight them to people at home, is their continued confidence in delivering low double-digit organic revenue growth. So here they're not talking about when they add the M&A in. The next part is significant opportunities for disciplined and strategic M&A. So what they're kind of saying to you here is, let's say 11% is your low double-digit organic revenue. Remember, that could be anything. They could be taking low as 30, low as 40. But let's say it's between 10 and 20. There's also opportunities for them to go out, use this cash that's generated from the 11% growth or 10% growth or whatever it is, to go out and make strategic M&A. And remember, these guys are Ashtead Group guys. They were spun out of Ashtead. They're literally Ashtead. All Ashtead do was M&A and grow that way. So it's kind of in the DNA. So yeah, I remain very interested in this company, and like I said, Steve, the April is coming around soon for the new tax year, and yeah, I've got some decisions to make with the ones we've covered today. I think Vistry, Ashtead Technology, Bloomsbury, not the most inspiring list of companies for me to go chasing after, maybe, but I'm pretty interested in all three of them right around here.
Interesting that you're kind of, not to put words on you there, but you're thinking UK sided rather than US sided. I mean, bearing in mind your prediction, by the way, for this year so far, that the FTSE 100 will beat the S&P 500 is going very nicely. As well as, I haven't seen actually how REITs are doing, so I've forgotten how that performance is going for you. I imagine that might be going all right too. In my case, my outperformers were Palantir and Diploma, and one of those is going quite well, and the other one's going quite badly. Palantir is still up on the year last time I looked, and the S&P 500 isn't. So that's going all right. And Diploma's letting me down at the moment. But like you, I'm also thinking UK-sided for my ISA in the coming. And despite the kind of relative slight closing of the gap in valuations and so on, I'm still seeing better opportunities closer to home. It's been an interesting show for talking about UK stuff, hasn't it, Steve?
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.